Hi, I'm Jessica Rabe, one of the co-founders of DataTrek Research. For today's video, I'm going to look at the historical return dynamics for the S&P 500. Let's start by considering just how well the S&P has done over the last couple of years. It was up 24% on a price basis in 2023, and it just crossed 20% this year. These all seem like big numbers, so how do we know if the index has gotten overextended? Check out this chart with the S&P's 2-year trailing price returns back to 1960. It shows that the S&P has rallied by an average of 17% over any rolling 2-year period over the last 6 decades. You can also see that the S&P is rarely down over 2-year periods. In fact, the index has had a positive return over any given 2-year period 82% of the time since 1960. It has only had a negative rolling 2-year returns less than a fifth or 18% of the time. As for how this relates to today, the S&P is up 57% over the last 2 years through today's close, which is a statistically unusual amount. That's between 1 and 2 standard deviations above the long run mean, which are 40% and 63%. The S&P's 2-year returns have exceeded 1 standard deviation less than a fifth or 16% of the time back to 1960, and it's only surpassed 2 standard deviations around 3% of the time over this period. Now, the good news is that the S&P has, on average, gone on to rally by its long-run mean of 17% over the 2 years after it's gained more than 1 standard deviation over the prior 2 years, like now. Additionally, when the S&P's 2-year returns have rallied more than 2 standard deviations, up 63% versus 57% through today, it's gone on to rally by 25% over the next 2 years, which is meaningfully higher than the rolling 2-year long-run average of 17%. These follow-on 2-year rallies demonstrate the power of price momentum, one of the most persistent factors in U.S. equity investing. So the upshot here is that history shows after an unusually strong 2-year performance for the S&P, like it's currently experiencing, the index still goes on to generate positive double-digit returns on average over the next 2 years. The follow-up performance may not be as strong as a prior statistically significant 2-year return, but that bullish momentum does continue. The historical data shows it will take a large exogenous shock for the S&P to have a negative performance over the next 2 years. Now, let's look at a chart that shows the S&P's 3-year trailing price returns back to 1960. It shows that the S&P has rallied by an average of 27% over any rolling 3-year period over the last 6 decades. The win rates are also quite favorable, with positive returns over any given 3-year period 84% of the time since 1960. Over the last 3 years through today's close, the S&P is up 31%, very close to that 27% long-run mean, and not statistically unusual. To be truly notable, the S&P would need to be up at least 56% over the last 3 years, the 1 standard deviation level. The S&P's 3-year returns have only exceeded 1 standard deviation 11% of the time back to 1960, and it's only rallied more than 2 standard deviations around 5% of the time over this period. Now, the key number to know here is that a 3-year return of at least 85%, or almost double, which is a 2 standard deviation move, signals markets are likely too frothy. So, like we always say, a double is a bubble. Fortunately, the S&P's 3-year returns are far from hitting that bubble territory. Looking at rolling 3-year returns also provides some historical context about when U.S. equities produce outsized returns and what can derail them. As noted in the chart, the best 3-year returns, up over 100%, come either deep into a bull market run, such as in the 80s and 90s, or exactly 36 months after a major bear market low, so 2009 to 2012 and 2018 to 2021. The worst 3 year returns, down over 40%, are due to terrible bear markets caused by a string of extremely adverse events. In 2002, US equity valuations fell under the combined weight of the dot-com bubble bursting, the 2001 recession, the 9/11 terror attacks, and the lead up to Gulf War II. In 2008, the pressure came from the bursting of the housing bubble, the global financial crisis, and the resulting Great Recession. Notably, the Federal Reserve monetary policy does not seem to play a decisive role in whether equities do better or worse than that typical result. Rather, 3 year return bands tend to run between 20 and 40%, regardless of interest rates. So, the upshot here is that being bullish over a 3 year time horizon is easy as long as you believe American companies and capital markets will continue to do what they've done for the last 6 decades, which is to focus on profits and innovation. As long as the next 36 months resemble the last 60 years, we see no reason why the S&P 500 can't continue to generate average 27% rolling 3 year returns. Finally, and getting back to where we started the conversation, longer run S&P returns do not look overly extended here. In fact, the index's positive price momentum should continue since it has plenty of room to run before signaling a reversion to the mean is on the horizon. With that, thanks very much for taking the time to watch this video. Please feel free to share it with anyone you think may find it useful, and as always, please hit the like and subscribe button to our YouTube channel if you enjoyed it. You can check out our website, datatrekresearch.com, for a free trial to our daily reports on markets, data, and disruption. There's no credit card or personal information required. Just drop an email in. Thanks again for watching, and we hope you have a great day.